All right, with the markets breaking down today, wanted to update the technical backdrop and kind of what we're looking at, not only on a very near-term basis, as well as an intermediate to longer-term basis. You can see here today, you're looking at a 1-minute chart of SPY, the ETF that tracks the S&P 500. And you can see we got a very bad breakdown below 1250, a level we've been talking about for a long time now. That 125 level correlated to 1250 on the S&P 500. And so had a really hard flush from 125.1 all the way down to 123.50, which is just an absolutely huge drop for these things. And you can see we had a nice trend going, but take a look at what happened here. After we lost that 125 level, this little channel we've got here, notice what happened on this bounce. We bounced up, and look where the sellers stepped in. Right around 125, an area of previous support, now acting as resistance. People don't want anything to do with the market right here, and we're likely to see this continue to happen. We're going to see bounces get sold because the technicals are horrible. That's just the bottom line. The market is now officially broken down. We will now look at a daily chart to see just what we're talking about here. Now, if you notice, if we look at a year-to-date chart, and you get right here, and you notice where we started the year, on numerous occasions, one time here in March, and another time here in June, acted as support. These year-to-date levels, break-even levels, they call them. And so really, we were range-bound between 1250 on the S&P and 1350, with a brief move to 1370 in late April, early May. But really though, we never were fully able to thrust above that 1350 level. And so you can see we had a lot of swings here, up, down, up, down, up, down. But now the market has really broken down. We're at the lowest levels of the year. The technicals are now firmly bearish. There's no mistaking that whatsoever. And if you look at a longer term chart, what we have here is a breakdown of a long-term support trend line here dating back to the March 2009 lows, and again the summer 2010 lows. We had a nice trend line here that had acted on support numerous occasions, most recently in late June when we had that latest bounce. But as you can see, for the first time in 2 years, we have surrendered that trend line. We are officially broken from the bull market trend that started in 2009, and now our next trend that we'll be paying attention to is this right here, this little, these are the lows from last summer, and you can see there's been some congestion even back in March of 2009 here. So we're pretty confident in calling this a support trend line. And you can see though, even today, we came pretty close to touching it already. This is going to be around 1220 on the S&P. again, we're looking at a weekly chart here. Keep that in mind. So, you know, this 1220 to 1225, 1230 range over the next couple weeks is going to become our target area that we fully expect to come down to, and that will likely be the next place where we may see buyers step in here. And what's interesting about that level, if you look and you extend it out, it coincides with the 2010 highs of April, just before the flash crash. So it's no coincidence. Trend line, price congestion here, it all comes together. So this will be very key in holding 1220. If we do not, we're likely looking at a test of 1200 even. And, you know, it's just hard to navigate right now. We think maybe if we get a bounce here off of this trend line, we're in the camp that it's likely to get sold because of the 1250 breakdown. We think that was a really bad breakdown today. And, you know, you should use rallies at this point as an opportunity to exit or reduce exposure to the overall equity market, because the bottom line is the technical backdrop is not looking very attractive right now. So let's say we do get a bounce. Let's go over really quickly what your levels to watch are going to be now. You want to focus on the theme of previous support now turning into resistance. So our first level is going to be the June lows right around 1260. Those will probably find some resistance here on any rally attempts. Further after that, really let's see where this is at, the 1295 level, which acted as support in April as well as in mid-July. So 1260 is your first level on the upside, then 1295. There's going to be resistance in between. There's a lot of trapped buyers who were buying above 1300. If you just look, we spent a lot of time above 1300 on the S&P. So there's a lot of people here who are stuck up here now, who might not be getting flushed out, but on any bounce attempt, we would think that these trapped buyers, as we like to call them up here, are going to be looking to exit positions and reduce exposure and take off a little risk. So let's talk really quickly about what trade is working here in this down market. And it's been the trade that's working for the last 10 years. That's gold. Is in a parabolic uptrend long term and showing no signs of slowing down whatsoever. Just have an absolutely beautiful trend line dating back to just before 2009 that hasn't been violated at all over the last couple years. And you can see we're even trying to push up against the top of that trend line and break out of the top channel here. So we are not commodity people. We wouldn't know what we were talking about if we tried to. But the bottom line is we can look at a chart and we can see that gold is in a clear, obvious uptrend with tremendous momentum, and it's one of the few trades out there that's working right now. As for support, you want to watch the 1500 level, 1450 to 1500 on gold. Pullbacks that hold this trend line over the next couple months, this is a monthly 5-year chart you're looking at, will be considered bullish, and the gold trade should continue to be respected as long as the trend holds. So that's really it. Just wanted to touch on things here. A quick recap on the S&P 500. We're going to be watching 1220 to 1230 on the low side for possible support, and then 1200 as a psychological level. Below 1200, it gets really teetery and really clears the way below 1200 for a move down to 1150. And that might just be what happens. We've had a great run here for a couple years, but you need to recognize when the trend is shifting. And after 9 straight down days in the market, the momentum is clearly on the bearish side. So you can't be a hero. Don't try and fight the tape. Acknowledge that the momentum has changed, the trend has changed, and adjust accordingly. That's all. Thank you.